The world is hanging on a mountain of debt. Total government, corporate, and household debt has ballooned to 315 trillion, or nearly 300% of global GDP. With just moderate interest rates, 10% of all the value we create each year evaporates into interest. Kyle, for decades, we have fine-tuned a mechanism to flatten the cycle. When things are bad, we pump in money to save it. But when things are good, we rarely pull the trigger in time. The result is a prolonged hangover. Cheap capital feeds zombie businesses, resources are locked up in inefficient places, and truly productive ideas are starved of oxygen. The most dangerous thing is not just the huge debt, but the misalignment. Money flows into noisy places, while the foundational sector is starved of capital. When markets don't get enough pain, warning signals are obscured, and the economy loses its ability to self-clean. This raises an uncomfortable question. Does America need a targeted recession? A slap cold enough to sober up, precise enough to cut away the excess, to get back on a healthy growth path? Or is it just a shock treatment that could easily turn a minor surgery into a major one? In economics, there are several concepts that are deliberately fuzzy to avoid shocking the system, and recession, is one of them. Most organizations agree that a recession is a prolonged period of weak or negative real GDP growth, often accompanied by rising unemployment. But how long does last? Some use 2 consecutive quarters as a benchmark, others 6 months or 9 months. Others rely on a broader basket of indicators, not just GDP. This flexibility is not arbitrary. Just labeling recession immediately changes the expectations and behavior of households, businesses, investors, etc. And that can turn premonitions into reality. To understand why we are sensitive to the word recession, it is necessary to recall the long-term picture. Since the Industrial Revolution, the world economy has grown by an average of about 3% a year. It sounds small, but compound interest over many generations has made today's annual output 150 times larger than in the distant past, while the population is only 7 times larger. On average, a modern person has access to 20 times more goods and services than their predecessors, although the distribution is very uneven. Because the trend line is so beautiful, any short-term break causes collective panic. We are used to moving forward, so even a single miss makes the system tremble. However, that growth line is not flat. There are years of decline due to supply shocks. Pandemics cause factories to close. Natural disasters destroy infrastructure. Conflicts disrupt logistics. These shocks are tangible. Production capacity is weighed down because it is simply not possible. But today, the more common type of recession is demand shock. Not because we cannot do it, but because buyers do not dare to buy, businesses do not dare to invest. The very human chain reaction, bad news, defensive saving, business cutbacks, layoffs, falling incomes, weaker demand, tightening the spiral. Since the 1980s, the developed world's macroeconomic stabilization policies have evolved, pumping money and fiscal stimulus to catch the economy every time it sneezes. This approach reduces the depth of the sinkholes, but it creates a behavioral distortion. When the weather is clear, we rarely pull the throttle. The result is a flattened cycle. We intervene quickly in bad times and let it run its course. Naturally, price risk signals become distorted, inefficient models are not tested by fire, and debt accumulates like grease around the arteries of the economy. Another scandal of recession is the data lag. GDP, employment, investment data take time to collect, review, and then release. It is not uncommon for an economy to be in recession for months before it is confirmed. So the debate, is it a recession yet, often lags behind reality. And when that debate takes place in the context of escalating tariffs, reshaping supply chains, and historic leverage, the fear grows exponentially. In short, the current context is a unique mix. Flexible definitions, prone to self-fulfilling effects, half-flattened cycles, high leverage, and looming geopolitical policy shocks. The next question is no longer how to define a recession, But what mistakes have we inadvertently fostered by fighting the pain for too long? In a healthy economy, inefficient projects will automatically leave the game when interest rates, capital costs, and profit expectations return to normal levels. Resources, capital, labor, space, attention, then move to places that create higher value. But when we over bail out, it leads to prolonged cheap money, horizontal support, in the belief that if something happens, someone will pick you up, which paralyzes the cleaning mechanism. As a result, weak businesses still exist like zombies, taking the place of better models and eroding overall productivity. Three common distortions. Zombie effect. Weak businesses do not withdraw, taking the place of strong businesses. Reallocation bottlenecks cause capital and human resources to be able to be stuck in noisy but low productivity places. Risk ethics is the habit of being rescued that makes people take risks with other people's money. Simple, easy to imagine examples. A faux restaurant that has been losing money for a long time. Each month it earns 90, spends 100. Normally it has to close so that the premises can be taken by a more efficient model. But thanks to low interest loans and debt extensions, the restaurant can survive for another 1 to 2 years. During that time, the neighborhood loses the opportunity to have a new restaurant that knows how to optimize costs, hire more people, and pay higher salaries. The real price is the opportunity cost of the entire area. An empty apartment, rental yield is 2% year, but when money is cheap, the cost of borrowing is also 1 to 2%. So buy, borrow, wait for prices to go up seems like a sure win. Capital that should flow into factories, warehouses, and source technology is locked in an apartment that no one lives in. When interest rates normalize, the surfing problem breaks. But 2 to 3 years of capital being locked up means 2 to 3 years of real production missed. Subsidy app, food delivery/entertainment app launches huge promotions thanks to abundant cash flow. Users think it is the right price, and businesses that do business properly cannot compete. When cash flow shrinks, apps collapse, the market leaves a void, consumers lose time, and consumption habits are distorted. Meme coin versus air compressor. A fun coin can attract billions of dollars thanks to noise, while a project to improve air compressors to save 5% to 8% of electricity for thousands of factories is difficult to raise capital because it is not attractive. Attention is also a resource. When it is misdirected, real innovation is starved of oxygen. In short, over-the-counter relief is like putting painkillers on a broken bone. It relieves the pain immediately, but the bone is at risk of mending crookedly. The zombie economy causes potential productivity to plummet, debt to swell, and risks to accumulate silently. History has had pains that have served the purging function, and what did they look like? In recent history, there have been two notable pains that show that the market sometimes needs a crash to purify and reallocate resources: the 2001 dot-com bubble and the 2008 housing credit crisis. Dot-com 2001. In the late 1990s, cheap capital and the expectation that the internet will change everything pushed technology company valuations sky high. Many businesses did not have a monetization model, but still raised capital as easily as loading a static website. Online advertising, burning money to gain market share, and user growth were seen as substitutes for profits. Then the bubble burst, stocks evaporated, mass layoffs, many companies disappeared. It sounds harsh, but this crash freed up three scarce resources. 1. Capital leaving virtual projects. 2. Talents leave money-burning teams to move to projects that create real value. 3. The media space is less noisy, making room for sustainable models. An easy-to-imagine example: a free food delivery app that lives on subsidies can attract users quickly, but if each order loses 10,000 VND, the larger the total loss, the deeper the loss. When capital flows tighten, the app is forced to close, leaving a gap for a business that lives on cash flow, reasonable fees, optimized operations to develop. 2008 crisis. The root cause lies in excessive financialization of real estate. Subprime credit, anyone can borrow, adjusted interest rates, and then securitization turn small risks into systemic risks. Rising house prices create expectations of buying to flip, while banks think they can sell off risks. When interest rates rise, borrowers are more likely to default, house prices reverse, collateral decreases, and the credit system freezes. It was painful, but the shock forced money out of house flipping for profit and into the real productive sector. Services. A simple example. A family takes out a loan to buy a second house just because prices will probably go up. When interest rates rise and rents cannot cover the profits, they are forced to sell at a loss. The capital locked up in that apartment could have gone into processing plants, cold storage, automated production lines, things that increase labor productivity. The interesting point, some countries like Canada or Australia at that time did not suffer the full pain thanks to more prudent banking systems and stricter supervision. But no big purge also has a downside. House prices have been climbing for a long time. The proportion of household assets invested in real estate is increasingly high, the kind of misallocation we talked about in Part 3. What is the lesson? Recessions are not automatically good, but the right adjustment can clean up the weak model, making way for the real productive sector. On the other hand, if the fall is allowed to spread like a chainsaw sweeping through a forest, even healthy young trees will fall. From here, we move on to Part 5. Why a little reduction in production sounds harmless in theory, but in practice directly hurts jobs, services, and daily life. On paper, it sounds harmless. GDP is a flow, wealth is a stock. If we do a little less, we still have the assets we created before, so why panic? But in real life, that break hits services, jobs, and cash flow, which cannot be stocked. Imagine a bread economy. Normally, the oven bakes 10,000 loaves a day, but suddenly, out of fear, it only bakes 9,000. The 1,000 loaves not baked today cannot be baked tomorrow because the bread spoils quickly. Labor, electricity, rent still run every day. Services are even more harsh. Haircuts, medical checkups, schooling, plumbing repairs, all consumed as soon as they are created. If you don't get a haircut this week, you won't get a haircut to make up twice next week. When services account for the majority of modern GDP, a little reduction means immediate loss of income for millions of people. A familiar example, the faux shop at the corner of the alley sells 200 bowls a day with thin profit margins. Demand shrinks, leaving only 160 bowls. The owner is forced to cut staff shifts. Staff lose income, reduce eating out, postpone buying new shoes, and cut phone data packages. Revenue from other shops, shoe stores, and mobile carriers all decline. It's a spiral of amplification. Reduced income causes reduced spending, which further reduces other people's income. But we still have houses and machines. Are those assets? Yes, but durable assets need maintenance. The city postpones painting bridges, replacing water pipes, and patching potholes to tighten its belt. Rust waits for no one. Infrastructure deteriorates faster, and the next repair costs much more, and may require closing bridges, causing congestion, increasing logistics costs, and further squeezing revenue in the surrounding area. Another pain point is debt. Many loan contracts, from credit cards, car loans, to floating interest rates, are calculated on the assumption of stable or increasing income. When revenue stagnates, the proportion of interest and cash flow swells, businesses and households are exhausted, forcing deeper spending cuts. Banks see increased risks and tighten credit, turning some people's liquidity difficulties into a lack of capital for the whole neighborhood. Even when inventory assets, such as houses, are still there, prices can fall when expectations worsen. The wealth effect makes families feel poorer, so they postpone large purchases such as refrigerators, televisions, cars, which has pushed the retail, assembly, and transportation industries to continue to hesitate. It seems that a 5% decrease in output is just a small number, But through the service, labor, debt, expectation channel, it becomes a chain punch to the wallets of many people living on monthly salaries. In short, recession is not just a downward line on the chart. It's the job loss of Lane the hairdresser, the cancellation of Hung the electrician's order, the delayed bridge repair, the ballooning credit card interest. And with escalating tariffs, reshaping supply chains, and record debt, the pain spreads even faster. Tariffs are not just policy, they are a market signal. When the U.S. raises tariffs on Chinese goods and vice versa, global businesses read three words: increased uncertainty. And with uncertainty, investment stops, expansion plans are postponed, inventory swells, cash flow shrinks, and growth weakens. How it spreads to real life. One is that increased invoices make buyers hesitate. For example, a small furniture store in Hanoi imports wooden chairs and components from China. Higher taxes make import prices increase by 8–10%. The store owner has three options, all of which are bad. Increase prices, making customers hesitate, sales decrease. Or keep prices, making profit margins as thin as paper. Not enough to pay interest. And cut designs/costs, making goods less attractive, turnover slow. In all three scenarios, employee income is affected, carriers have fewer orders, and even satellite carpentry workshops are unoccupied. Second, the supply chain shrinks. New costs appear. Deglobalization, friendshoring sounds fancy, but it means moving the chain to a place with less political risk. For example, an electronics company moves part of its assembly from China to Vietnam, India, Mexico. The problem: reinvest in the factory, train workers, redo quality certification. Broken components. A chip still has to fly from the old place. The time is longer. The cushion inventory must be thicker. Mixed costs, transportation, insurance, equipment maintenance increase. When marginal costs increase, selling prices increase. Inflation is pushed up. The central bank is difficult to loosen. The tightening circle takes longer. Third, uncertainty freezes big decisions. A textile factory plans to upgrade its $5 million production line, but it doesn't know what the import-export tax will be in 6 months, or if orders from the US and EU will change standards. The safe solution is to wait. Every wait decision by a business is a delayed order from a machine supplier, a fewer contracts for an installation company, a loan that is not dispersed by a bank. The economy is like a clogged highway. Just a few cars suddenly stop. The entire lane behind stops. Fourth, a mountain of debt turns a push into a fall. If cash is blood, then high debt is high blood pressure. Just a small bump, taxes, missed orders, increased shipping costs, can cause a broken vein. Households borrow to buy houses with floating interest rates, causing income to decrease, interest rates to increase, liquidity to break. Small businesses use revolving credit lines. Banks see increased risks and lower the limit. Coffee shop owners have to cut shifts, suppliers lose orders. Governments with large amounts of debt have to roll over debt in the context of worsening growth expectations. Mobilized interest rates inch up just because of perceived risks, causing interest costs to swell, crowding out other useful spending. Taken together, tariffs plus the deglobalization plus high debt turns local adjustments into systemic shocks, distorted price signals, shrinking investment, sticky inflation, and eroded confidence. If we view targeted recessions as selective hunting, then what we are doing is easily shooting at the whole herd. So what is the way out that cools down with a target instead of general anesthesia? To cool the economy without pushing patients into the intensive care unit, we need a scalpel in the right place instead of a chainsaw. The following set of solutions targets the distorting hotspots while maintaining the rhythm of life for normal people. 1. Tighten the target, remove horizontal relief. Speculatory real estate. Tighten LTV/DTI for second homes. Increase credit risk coefficient. Limit interest deduction for short-term rentals. Zombie. Support has a limited use period and is accompanied by a stress test. Businesses that cannot pass must restructure quickly, exit the game to clear land, labor, and capital. For example, owners of empty apartments must deposit 50% of their own capital and cannot deduct interest, leading to less holding the house and waiting for prices. Capital flowing to factories, warehouses. Prolonged losses can only be deferred for 6 months with a commitment to reform and, if not achieved, liquidation for new people to do better. 2. Create incentives for reallocation to real productivity. Conditional credit/incentives for R&D, automation, energy efficiency, accelerated depreciation for 5 and energy-saving machinery. Public bidding prioritizes productivity-enhancing models, cold logistics, smart ports, digital grid. For example, a mechanical workshop invests in a $3 billion robot, is accelerated for 2 years, and gets preferential loans if it saves 7% of electricity. After 18 months, output plus 20%. If the electricity bill costs 8%, it will be self-sustaining without subsidies. 3. Cyclical discipline and clear exit rules. Counter-cyclical fiscal, stimulate when unemployment increases, automatically withdraw when unemployment, 5% for 3 consecutive quarters. Monetary, special measures as asset purchases, emergency loans, with public withdrawal thresholds, e.g., core inflation to target zone plus narrowing output gap. Easy to understand example. The government announces a traffic light, green light, unemployment 4.5%, inflation 2%, leading to a temporary reduction of tax exemptions, reductions of 0.25% of GDP per quarter. Businesses see a way out so as not to take on new debt indiscriminately. 4. Anti-shock Social Security, maintaining the base demand but not distorting prices, reducing working hours with subsidies on short-time work instead of layoffs, retraining vouchers linked to industries lacking human resources, electrical, mechanical, healthcare, flexible unemployment insurance with requirements for skills learning, mobile welfare for gig workers. For example, Ms. Yu, a hairdresser, reduces her work from 6 to 4 days a week, receives 60% of the compensation, free time to study a skincare certificate with a voucher. After 3 months, her income will increase without having to leave the labor market. 5. Reducing trade friction, prioritizing intermediate inputs, green corridor for components, chips, pharmaceuticals, mutual recognition of some standards to avoid chain congestion. For example, a tailor in Binduong has a fast quota for zippers and linings, not 3-month inventory, freeing up working capital. 6. Manage debt wisely, reduce system pressure, extend public debt maturities, swap maturities when the yield curve is favorable, cut off sub-target subsidies to balance the primary. Households/businesses, encourage fixed interest rates, early refinancing. Banks apply early warning to restructure debt before failure. For example, an electrician changes a home loan from floating to fixed for 5 years, pays an additional 0.3 percentage points today to avoid shocks next year. The goal is to reduce the heat with a goal, hit the right risk points, protect the heartbeat of employment consumption, and maintain confidence in long-term investment. If done carelessly, we will turn a plastic surgery into a major surgery. When the world is hanging on a mountain of debt, 315 trillion USD, many years of overhelp have distorted market signals, fed zombie businesses, and stuck capital in inefficient places. The history of 2001 and 2008 shows that pain in the right place can purify and reallocate resources, but chainsaw will destroy healthy young trees. In fact, just a small output reduction will hit services, debt, expectations directly, while tariffs, deglobalization, and high leverage turn local adjustments into systemic shocks. The way out is to cool down with a target, tighten the right hotspots, speculative real estate, zombies, encourage real productivity, R&D, automation, infrastructure, discipline according to the cycle with clear exit rules, shock-proof security, and wise debt management. The economy is like a steel ship rushing through icebergs. If we were to use a chainsaw, one wrong move would tear the hull apart. What we need now is a blacksmith's scalpel, cutting the right crack in the weld, replacing the right weak steel plate so the ship can maintain speed, overcome the ice, and enter the open sea. America doesn't need a coma. America needs a conscious operation. Now it's up to you. Do you choose a scalpel or a chainsaw? Which solution do you think is the most accurate? Curbing real estate speculation, stopping zombies, or boosting R&D and retraining? Comment below. Have a civilized debate for a deeper analysis. If you find the video useful, don't forget to like, share with those who need a wake-up call, and subscribe with the bell so you don't miss the next economic analysis. Thank you for watching until the end. See you in the comments.